All right, welcome to this new spring enrollment video where we will go over the retracement. And with the retracement, I mean, how far can price retrace before it actually wants to continue higher? This is an extremely important element to understand in your trading as well, because all the trades we are going to take need to be somewhat accurate. We don't want to take 3 hits, 3 losses, for example, before we actually take the next winner. Everyone can find that winner. But we want to be that accurate that we don't have to take those losses before we take the next winner, which eventually, of course, leads to a simple logic of that will make us profitable. So then we need to have an understanding of the exact PD rates that we want to trade off of in order to achieve that accuracy, which is again, small little reminder, if you are looking to incorporate any other thing, then this is not going to work because then it mixes the whole recipe. If we are cooking, I'm not sure, an egg, and we have a certain recipe for how that egg should taste, if we now mix in different things, the egg is not going to taste the same. It might even taste like absolute garbage. Who knows, right? So with that being said, let's remind ourselves again of what we went over in the previous video really quick. Narrative. That is this week's topic, right? We need to go over narrative. Now, first things first, we understood the bias. So we have a brief understanding of the bias, the direction that we want to head towards. Then the next part after the bias is the narrative. How are we getting there? So if we are going higher, where are we going higher from? That led to an overall understanding of the order flow lags as well. We can go higher off those order flow lags, but those order flow lags have quite a lot of PD rays in them usually. They have a fair value gap, they might have an order block, they might have a swing low in the middle, something like that. So if we want to be accurate, we need to exactly know at which PD rates we can actually look for a future entry. So here we mentioned PD rates right there, the flood, the odd and lot, and those PD rates dissected again. That is what we mentioned in the previous video. Now, moving on from that understanding, we now need to go over how far can we actually retrace. First thing that is extremely important to understand is resistance determines retracement. So what I mean by that is, and before we dive into that, let's first go over what is actually resistance. Resistance is, at number 2, we see opposing PD rays. So what then is opposing PD rays? In a bullish trend where we have discount arrays holding and the market is pushing higher off of discount arrays holding, opposing PD rays will be premium arrays. So a bullish trend is premium arrays as resistance. The resistance is always an opposing PD ray, where a discount array where we are expecting higher prices off of, that's not a resistance area. That is just simply where we expect higher prices off of, just simply a discount array, a PD array that supports the price of going higher, the overall order flow. But if we then reach into premium arrays, they will act as resistance. That is our resistance, the opposing PD arrays. Same, I'll give you an example for a bearish one as well. If we have a bearish trend and we have bearish order flow established, premium arrays are holding. So discount arrays will act as resistance. Now, why is that important as well? Before we dive into that, last thing here, on the same time frame or a time frame above us. So what I mean by that is an opposing PD ray. If we are looking at a discount array on the daily time frame to hold, then we can find opposing PD rays either on the daily, on the weekly, and on the monthly. If we have premium arrays and we have premium arrays holding, we have bearish order flow established, then the discount arrays will act as resistance, those opposing PD rays. Let's say we are trading the 15-minute time frame. And the 15-minute time frame right there has opposing PD rays. Then we find the opposing PD rays on the same time frame or a time frame above us again. So the goal is there that we do not, if we are trading off a 15-minute fair value gap, we do not go into the 1 minute to find the resistance. Because again, the 15-minute is already stronger than the 1 minute. So it can't act as a resistance because it is weaker. Where a daily fair value gap higher, daily discount array is running into a 1 minute fair value gap premium array. That 1 minute fair value gap is not resistance for that daily discount array. because it's a lot stronger than that 1 minute time frame. So if you're using the 1 minute, then it's going to be resistance on the 1 minute or above, 5 minutes, 5 minutes or above, 50 minutes, 50 minutes or above, 1 hour, 1 hour or above, and so on and so on and so on. That is quite important to understand, where the monthly only has the monthly time frame as resistance as well. So that is what we call resistance. That is what we call then the opposing PD rays, and how we select them, and what actually are those opposing PD rays. So then the opposing PD rays, in other words, the resistance, that determines how far we will retrace. That determines the retracement. So what does that mean? Well, if we take a look at the pushing battle, this is a concept that I like to use when I like to make it clear for myself how far we can actually retrace. It's a pushing battle. And I often refer in previous enrollments to it as well as a balance theory, where if we are in balance, etc., between two PD rays, we will retrace further. But I think an easier explanation right here is the pushing battle. So what is the pushing battle? We have a red hand right there, and we have a green hand. The green hand is a discount array. The red hand is a premium array. The bigger the red hand, the stronger the premium array. The bigger the green hand, the stronger the discount array. Now, this red hand, the first one, is not that big, right? It's quite a small red hand. That is a PD array. And why those hands? Because the way I want you to see it is, if we have a strong discount array that we are pushing higher from a lot, with a lot of intention, you could see that as someone in the market is trying to push at the best of its capabilities, trying to push higher as much as it can. That will leave behind overall fair value gaps. That's why the push is so strong. Then we run into those opposing PD rays, and those opposing PD rays right there, if that's a strong PD ray, if that's strong resistance, we will see a red hand right there in the form of those premium rays try to push price lower a little bit. So then between that bullish hand and the bearish hand, it becomes a pushing battle, where if both are really strong, we will either create a consolidation, we will either create big retracements before we continue higher. But usually what is the case with overall nice order flow is one side of the market will not be so strong, but will still have somewhat of resistance, will try to push lower in the form of that red hand right there. Can't do it very strongly because it's not a strong premium, it's not strong resistance. And that leads to only a sting into that first line of defense, into that first fair value gap, to then continue higher off of that. So in the opposite right there, we have a red hand, a big red hand, and a big green hand. Now, when this happens, we create a bullish move higher, which leaves behind a lot of intention as well. Again, those fair value gaps. It's pushing higher significantly. Then that red hand is quite big. So since that red hand, that strong premium rate is also quite big, quite strong overall, that can push price lower for a little bit as well, because it's a significant premium rate. It's what exactly is a significant premium rate is exactly what we're going to go over after this. I'm just trying to show you how I view this in my mind. It's a pushing battle. So this right here, when we push lower, I'm not necessarily expecting the first line of defense to hold. I'm expecting either a fair value area or the next fair value gap, for example, to hold, to then continue higher off of that. Since it's a strong hand, the retracement can be bigger as well. Now, how do we exactly view this? How can we know what is a strong premium rate, what is a weak premium rate, what is strong resistance, etc.? All things we are going to dive into now. I hope this is clear, where whenever we look at price action, we can see always a strong hand and a weak hand. And that is how we move from a retracement, a big retracement, or a small retracement. That is seen again through those resistance areas. Now, moving on from that, and I'll show you a few more examples as well, of course, in the chart after this. Strong and weak resistance, question mark, because what does that actually mean? As in, what is strong and what is weak resistance right there? First things first, right here, we have an FVG fair value gap plus a fair value area. FVGs and FVA usually lead to a bigger retracement. This is strong resistance. So let's say we have a discount array and we are trying to push higher from that, then a fair value gap or a fair value area that we had towards the left side of the chart still, that can lead to a bigger push lower as well in price action. So what does this actually look like? So if we take a look at NASDAQ right here, then we see this breaker sitting right there with a fair value gap right there, of course. So it's a fair value area, essentially. And that fair value area is where we can expect somewhat of a resistance, because if we now want to continue higher, we have this order flow leg right here. And this order flow leg is where we can now look to continue higher off of. We have a first line of defense, we have the overlapping defense, and we have the last line of defense right there. Now, what usually is the case is when we have a fair value area or a fair value gap towards the left side of the chart, so not in current order flow right there, we can see a bigger retracement right there to continue a little bit lower into usually what is the case, an overlapping defense instead of just a sting into a fair value gap to continue higher off of that. So the resistance right there determines again how far the retracement will be. And if we look at this scenario right here, then if we now want to continue higher, we can currently do that off of these two candle rejections where eventually we can follow through. And after that, we don't have a lot of resistance anymore. On the 4 hour at least, we don't have a lot of resistance anymore. So let's say if we now create a 4 hour value gap right there, then that 4 hour value gap will likely only have a sting into it to then continue higher. That's the first example, and we will go over multiple examples as well. But before we do that, I want to go over swing points. Swing points usually lead to a bigger retracement if we sweep it. So swing high, swing low, if we sweep that or have early signs that we want to sweep that, that leads to a bigger retracement. That is strong resistance. Now I also need you to understand, if it's a run on liquidity, it's weak resistance. So let's first go over what actually is that sweep, how we can identify that sweep, and then let's go over what that run is, and then let's see what the difference between the two retracements are. Now, before I show you the live price action right here, I want to retrace the steps that lead to a sweep on liquidity. Because a sweep on liquidity is not just all of a sudden, hey, it's all of a sudden a sweep. No, there is steps that we can retrace that leads to the understanding, hey, this might be a potential early sweep actually. And nothing confirmed yet, but it's premature signs that we might be getting a sweep. So what do I mean by that? We have this low sitting right there. If we are sweeping a low, then what happens is, first things first, we will have signs. So first things first right here, what we get is we see that we do not have a fair value gap exactly overlapping with the low that we just took. That is the first sign that we might get a sweep right there. Is that confirmed? Absolutely not. But once we then create a new fair value gap higher above the liquidity right there, a bullish fair value gap, this right now confirms a sweep. Because now we have a fair value gap going into the liquidity. This fails to close right there below that low, or at least fails to create a new fair value gap below that low, exactly overlapping with that low. Creates a new bullish fair value gap going higher. That now confirms the sweep. Where if we take this example and we compare it to a run on liquidity right there, where with a sweep of liquidity, when you see this, we are expecting opposing liquidity in the form of the highs right now to be targeted instead. So we sweep one side of the market, a swing low, we have the sweep, then we target a swing high instead. Where if we take a look at a run on liquidity, whenever we have a run on liquidity, we expect it to just continue lower. So from this discount array, that swing low, targeting a lower discount array in the form of this, for example, in the form of new discount arrays that we have right there. Where the sweep is discount array to then premium array. A run is a discount array towards the next discount array. So what is the difference between this price action and this price action? Well, right here we see we are already closing with a nice fair value gap exactly overlapping with the low that we took right there. That is already a great sign that we do want to continue lower for a little bit right there. Then once we come into it, we respect that fair value area to then continue lower off of that. So now that you have the basis understanding here of what a sweep for the run on liquidity is, we can again retrace those steps. And that determines how big a retracement will be. So let's look at a couple more examples. Right here, we are on GBP US dollar. And what you can see, I have marked out this fair value gap and this fair value area right there. Now, before we retrace back into that, we actually reach this swing high right there. And what are some signs that will tell us that we will not only retrace back into this fair value gap to then have a sting, to then continue higher off of that, but that we actually want to reach back into the fair value area to then continue higher off of that? Well, is this showing early signs of a sweep or a run on liquidity? This is showing early signs of a sweep of liquidity. Again, I need you to understand that just because it's showing early signs does not mean that it actually is a sweep. The way we operate in the market is always probabilities. So there's a higher probability of one thing happening over the other thing. Right here, we see that potential sweep, and that should ring an alarm bell where it's like, okay, that's a little suspicious, because if we were truly very bullish, remember those hands we were talking about? If we had a very bullish hand right there, that bullish hand should have created right now a fair value gap overlapping with this exact high. Now we have somewhat of a bearish hand sitting right there at that premium rate that's trying to push price lower a little bit. So when that happens, we can already see that by this fair value gap not being created with the exact high that we just took. So what does that mean? Well, that means that if that does not happen, we can expect a bigger retracement for if we do want to continue higher. So right here, if we do want to continue higher, it's not the fair value gap right there. It's the fair value area right there. If we expect a bigger retracement, we expect the overlapping defense to get traded back into, not just a simple sting into a fair value gap alone. Where this eventually is what we can now continue higher off of. Now, if we go over one more example as well, here we are on our beloved GBP Canadian dollar. We have been going over this quite some time because it's showing the perfect examples as well right here. And we mentioned order flow. We have mentioned this in the order flow episode, in some of the candle signs episodes as well. And right here, I want to look at this swing high that we just took right there. That swing high is again showing early signs that we might want to sweep that high right there. So when we then potentially sweep that high, what do we see? No fair value gap overlapping with the high that we took, not even a close above it. It's just wicking right there. So if we then take a look at the most recent order flow leg we had right there before we want to continue higher, then what do we see? We see, again, a very strong, can you now see how the hands become stronger and stronger and stronger, where here, this bearish hand is a lot stronger. Why? This first line of defense is now actually that order block and not a fair value gap. Remember what we said in the last episode, where if a fair value gap is the first line of defense, that's the highest probability thing to happen. Why? Because of the bullish and the bearish pushing battle. Those two hands, they are pushing. And if we truly have one very strong hand that can push price higher, we will always create a fair value gap as a first line of defense. So right here, we now create this price action. Now this price action would have me saying right here, and we mentioned this in the forecast actually, I would almost want to look at lower prices right here. Why? Because the premium arrays right there, the bearish hands are pushing that strongly to the downside right here. Where if we do want to continue lower, then we can just simply continue lower off of that sweep that we have right there, where I would believe, all right, well, I do not think these discount rates right there are good to actually trade off of, because we have so much bearish momentum, bearish intention actually moving into a discount rate. The way I want you to see that is, if we want to continue higher, the ideal scenario is when we have zero bearish intention and just by coincidence, we create a retracement to continue higher off of that. Because then price will explode higher. It will absolutely go off. It's like almost like we've seen with Bitcoin reaching an all-time high, where if we get a retracement, get in because it's an explosion higher after that again. Now, what happens as well is, and this is where you need to be careful, is right here, when we have a higher prices, we have a strong hand pushing, but then we get a strong hand pushing lower as well. That creates a bigger retracement. And that bigger retracement is so extremely important to understand. So you won't take 5 losses before you might take a winner on a certain pair. Because the entry pattern is knowing where you should get involved. It's also knowing how far we can retrace. Where here, I would not be happy to go into the lower time frame to look for my entry pattern straight away. Because I already know the way we are coming into that discount rate is just not interesting to me. So now you can potentially also see an earlier example that we had in previous videos where we have silver and we run this high right there. And once we run that high, we are not expecting a big retracement, either the fair value gap alone or that fair value area. This area right there is where we expect the retracement to happen. Below that, no, not really, because now we're running that high. And again, see those hands where here we have a lot of bullish hands pushing higher. There's not a lot of bearish hands right there pushing lower or trying to push lower as well. So that leads to a more bullish intention. Very simply said, when we have a lot of bullish intention, can we reasonably, logically expect a big retracement? No, because there's a lot of bullish intention in the market. When we have bullish intention, but also a lot of bearish intention, what does that create? A lot and a big retracement. That is very important to understand. So the swing points right there can lead to both strong resistance, but also weak resistance, depending on if it's a sweep or a run on liquidity right there. Now, next thing is no man's land. The area where we are not running into any resistance, expect a small retracement. This is also what I like to call as the no resistance run. You might know it through other concepts, etc., as a low resistance liquidity run. This is the no resistance run. It's a little bit easier to understand. It lines up better with what we have been talking about as well. So looking at Australian dollar, US dollar right here, we can see before we had this huge move higher, why did I actually expect this, once we take out that high right there, that we will absolutely explode higher? There's a reason for that. Because if we take a look at this price action and we take a look at what happened before right here, we trade into this order block right there and we continue lower off of that. After that, if we want to continue higher right now, we are sweeping those lows and we run into this order block as well, which we could potentially see some resistance forming, right? After that, if we now retrace our steps a little bit, we have traded into that order block. We have traded into this order block. We have traded into this order block. We have traded into any fair value gap that might be sitting right there. So what happens? We only have swing highs left for us to now target. We have this swing high. We have this swing high right there. After that, we have this swing high. After that, we have this swing high sitting right there. After that, we have all these swing highs. The only real resistance that we run into is now, what is the next premium rate that has not been traded back into? This right there. And we can even say, if we zoom out on the daily time frame, then we had a daily fair value gap sitting right there that has not been traded back into. Again, resistance is on the same time frame or on the time frame above it. So I also need you to understand right there that once we trade into an order block, into a fair value gap for the first time, that is already gone. It's gone. It's not relevant anymore. So where a lot of people would look at this order block right there, would now draw their Fibonacci, would say, yes, but we have the 50% level right there. Not relevant. It's extremely irrelevant, and that is not what I would advise you to use. Because when we do trade back into that 50% and we do reject off that, then we are not rejecting off the 50% most of the time. We are rejecting off of the swing high that was created there, or the previous candle that was created there, not the 50%. So right now we only have swing highs left to target. So we have a full no resistance run right here until we reach these two lines right there. So that then leads to understanding that if we can catch a trade before we dive into this area right there, because that is where the no resistance run is now over. That is where the rejection off of that last order block where we can continue lower off of will be done. And when that rejection is taken out, we will absolutely explode higher. So that is what we eventually see sitting right there. And that is why we have that explosion higher and why we stop right there. Because we are running all these highs right here. Small retracements between these areas. So between, let me mark it correctly right now. Between this area right here, where we continue higher off of that fair value gap, and the first resistance areas that we have in the form of fair value areas, fair value gaps, and we are running those swing highs. That is where we can only expect a small retracement to happen because there is no other resistance. So if you want to refine that a little bit more, then between every high right there, the next swing high that we have sitting right there, between every single one of them, that is where we now expect a small retracement. So from this area towards this area, expect a small retracement until we reach that new premium rate. From this area towards this area, expect a small retracement until we reach this premium rate where we can potentially sweep it. From once we then continue higher from the next area to the next area, expect a smaller retracement. This then leads to the understanding of the no man's land, where we're not dealing with any significant resistance, and especially we're not dealing with those fair value gaps, with those fair value areas, only swing points. That's where we can expect price to run. More on this we will also go over later. Before we dive into the next thing, I want to also mention that we will have case studies as well regarding this. So if it doesn't make full sense right now, don't worry, this is only the tip of the iceberg. This is only the introduction. So right here, if we now understand those strong resistance versus weak resistance, let's understand the flood, the odd, and the lot. So what do we do with that? Where can we now continue higher off of? The flood, the odd, or the lot? That creates a hierarchy. The flood should hold if we are not running into strong resistance. So the things I just mentioned, the fair value area, the fair value gap, in the previous slide where we expect a sweep, for example, that is where we do not necessarily expect the flood alone to hold. So if we do not expect the flood alone to hold, if flood doesn't hold, aim for the odd right there. Aim for the overlapping defense. Now this also leads to the understanding, when a flood does not hold, you're always expecting the overlapping defense to hold unless we create fair value gaps going into the overlapping defense. Later on that, we'll go over that later on as well. Now that leads to understanding of the third point, odd should hold with two candle rejection. That two candle rejection is what we talked about in the previous video. That now creates the understanding of, okay, that is actually the last line of defense. Then if odd fails, the target becomes the lot. So we do not want to trade off that lot, the target becomes the lot. So what does that look like? We already went over this a little bit as well in the previous video, and I will go over it here again. So looking at GBP US dollar again right here, then we had this flood sitting right there. That first line of defense, which is the fair value gap. But we also had those early characteristics of what might be a sweep. So we already expect a bigger retracement. So then the flood does not hold. We expect the odd to hold, or we trade back into the odd. That is our expectation, that we trade back into the odd and continue higher off that with a two candle rejection. So right here, this is where now it gets very interesting, because now we have that two candle rejection sitting right there. So now the last line of defense, again, is not these lows right there. No, when the two candle rejection here starts to fill right there, and we do not continue higher actually, then the lot sitting in the form of that swing low of that order for lag actually becomes the target right there, instead of something you are looking to trade off of. It becomes the target. So that is extremely important to understand as well. Now, this creates a basic understanding of how far we can actually retrace. But can we now actually, once we have the retracement, actually continue higher off of that discount or premium array, continue lower off that premium array, of course. That is where we need to focus on the day. And what I mean with the day right here is where we need to focus on which day should a PD array hold. This is extremely important to understand as well. So for the US dollar, the day with red folder news for the US dollar, that is the day when we reject right there. That is where we expect higher price of that. For the crosses, the day with red or orange news right there. So what do I actually mean with this? That day is where we have the volatility. If that day does not reject, then that's not the true intention. So the way I want you to see news in this case, and why we all of a sudden now incorporate news is time. So time is extremely important to tell us if we actually want to push higher or push lower. It will tell us exactly what the true intention is. Price can only do so much without having time to back it up as well. It needs time, because time is the actual volatility. The way I want you to see news is, especially here, the economic calendar, news, it's an alibi. It's a smokescreen for what is really happening in the market right there. So the news will always tell you exactly what it actually wants to do. So what I mean by that is, if we take a look at this first example, the arrow right there going higher, we have a fair value gap sitting right there on the left. We come into that, and on that news day, right there, that's why the arrow is pointing towards that. On that news day, we have a rejection going higher. That means that the intention is actually to continue higher as well, because news is supporting the idea of higher prices. Well, if we take that idea and we look at this example on the top right, we see the same exact schematic. So we have this fair value gap as well, the same news day. But news right there is now disrespecting that fair value gap, showing early signs that it wants to disrespect that fair value gap. So since we are not rejecting off of that fair value gap higher right there, on a news day, that indicates that we do not actually want to continue higher. We want to continue lower already. So we can already have early signs that we want to continue lower. So what does this look like in the chart? If we take a look at the economic calendar first right here, this is forexfactory.com, not affiliated or anything, but this is what I've always used in my trading. I have the following filters right here. I have it set like that. You can pause the video if you want to copy it as well. Now, what I focus on right here, if we first focus on the US dollar red folder news, then we can see Monday, we do not have red folder news. On Tuesday, we do have a red folder news for the US dollar. So that already creates such an extremely interesting scenario, which looks like the following. If we now compare this right here with an actual chart, then we see on that Monday right there, where we had no red folder US dollar news, we are coming into that fair value gap right there, and we already have a rejection. So based on candle signs, we could already assume, hey, this actually wants to continue higher already. But during the forecast, I've mentioned this during the live sessions as well. No, we cannot continue higher right there, because the rejection is not supported by the fundamentals, which is in this case time, which is in this case, again, the economic calendar news event. So that is where this rejection right there can still get taken out for a bigger retracement, where on a day where we do have red folder news supporting the ID sitting right there. And now the rejection on that Tuesday is supported by the ID that we have red folder news. So what can we expect for the next day? That this is actually the rejection, and we can now look to continue higher as well on that next day. And if we take a look at the same example on Australian dollar, US dollar right here, once we take that high, and we already run into a few fair value areas, fair value gaps with that Monday candle. Monday, I mentioned, this candle can still get taken out because we don't have a US dollar red folder news supporting the ID right there. So then we have a rejection the next day, where that rejection is being supported by the ID that we also have red folder news. That is exactly what we want to see, because now we can be confident that that is actually a rejection. That is actually supporting the idea of continuing higher. Now, we also had another example where this is the first example that we had, but we also had another example where it's not the true intention. So what does that look like? Here on the forexfactory.com again, we see Thursday right there, 15th of February, where we have US dollar red folder news right there. Now let's see how that reflects the market. On New Zealand dollar, US dollar on that particular day, if we want to continue lower, for example, off of this fair value gap sitting right there, then we have the economic calendar news supporting the ID right there. So this candle, that Thursday, the 15th of February, should have already been a big rejection actually continuing lower. After that, we should not see any higher prices anymore. So the higher the close at this moment in time, the worse it essentially is for lower prices, but the better it is going to be for higher prices. So right here, this is an early sign since we do not have a big rejection, a close below the order block, a close below the fair value gap. That indicates that the true intention is not to continue lower, it's actually to continue higher. Because if we are running into a premium array where we expect lower prices off of on a news day, then we should continue lower and reject off of that premium array. If that's not the case, then the intention is not truly there and we will actually see higher prices instead right there, targeting the last line of defense again. A very clear example of this is exactly the same day, the 15th of February right there on that Thursday on the US dollar itself. We have that fair value gap, which we can continue higher off of. We have the overlapping defense even right there. Then once we close this down candle right there, and even earlier signs as well, which we are going to dive into later on in the spring enrollment, then this right here is, we have new supporting ID, we have the flood, even the R right there, which we can continue higher off of, and it fully disrespects it, everything right there on a news day. That indicates that the true intention is not actually bullish because we should have rejected right there. So the true intention is actually to continue lower instead towards these lows sitting right there, towards then again, the last line of defense. So this then creates the understanding on which day we should actually reject. And if that day does not reject, then the intention is not truly there. It's an extremely important concept to understand as well, because it will filter out a lot of bad trading days as well, or where you are still expecting higher prices, you can simply ignore those higher prices and can potentially look to continue lower instead. More on this later on. I just wanted to introduce you to this concept as well. We will have full videos on time later on in a separate video as well. Now, moving on from this, I want to go over a few case studies right here. So these are screenshots that I took yesterday. Actually, this is the dollar. This one I took yesterday. This one I took just before I went to bed right there. And on the left side, this is the one I took earlier. We see this fair value gap, that fair value gap, the gray box, will not hold, or it will have a big retracement into it before continuing higher, but not just a sting. In this case, I want to now apply everything that we went over already as well. Then on the right side, I mentioned a big retracement here. So we can expect a big retracement higher a little bit right there. Once we reach the gray box, we will see no big retracement anymore, no significant retracement anymore. So this right here is referring to, we are running into somewhat of resistance right there on the bullish prices. We can expect a bigger retracement, not just a sting into that fair value gap, that bearish value gap, to then continue lower. And once we continue lower, we can expect that there's no big retracement anymore in that gray box until we reach those lows sitting right there. So now let's dive into the full thought process on the dollar. Now on the dollar right here, we can potentially continue lower off of this fair value gap right there. We see again, Monday stings into it already. Monday doesn't have US dollar red folder news to support the ID. So that rejection, when we create a 2-candle rejection and we don't have news supporting the ID, you can ignore the 2-candle rejection and we might just sweep that rejection again to then continue lower, which is exactly what we're seeing right here. So the first candle rejects. We don't expect respect because we don't have news supporting the ID actually. So then afterwards, we have this Tuesday huge down candle that is forming with news supporting the ID right there. Perfect. That's exactly what we would want to see. So right now, how can we now continue lower right there? Well, on the 4 hour, what do we see? On the 4 hour, we have a 4 hour fair value gap sitting right there going against us. That 4 hour value gap is because, again, remember those bullish, those bearish hands right there? That is exactly what I'm looking at right there. Because here, when we have that bullish hand pushing higher quite heavily, but there's a very strong bearish hand that I'm not expecting just a sting into this fair value gap if we do want to continue higher off of that. No, I'm expecting a bigger retracement into somewhat of an overlapping defense to then potentially continue higher, or it just, with the understanding of the daily right there, since it's stronger, not hold at all right there. So right there, if we do want to continue lower, then we have this 4 hour value gap that we can continue lower from. But what are we also seeing? That if we go into the 1 hour, we'll get a clearer picture. On the 1 hour, we are running into resistance right there in the form of that overlapping defense, which we can again continue higher from. So this 4 hour value gap lower right there is not where I would expect just a sting into it to then continue lower. I would expect a bigger retracement. Why is this so extremely crucial? Because let's say I were to dive into the 1 minute, 5 minute time frame, whatever it may be, to look for an entry right there, then I will get taken out before the real move actually happens. So the entry is not going to be that accurate. That is so extremely crucial to understand, because when we build onto this understanding, then our entries will be extremely accurate. And I'm not going to promise anything, but the win rate, the amount of profitable trades you will have if you understand this concept, and if you understand all the videos that we have gone over thus far, you're going to be an insane trader. I can almost confidently say that if you follow along with the videos. So right here, I mentioned that once we reach this low right there, we will have no big retracement before we continue lower. Now, what do we see? We have one up candle, but in comparison to what we have seen on both the bearish side, the bullish side, this is not a big retracement before we actually continue lower. That's where price right there happens fast, where the only resistance that we have, the only real dangerous signs that we might have is that up candle is explainable through that we might be sweeping that low right there. But with the overall premise that we had, we can say this is where the faster price action will happen below that low right there until we reach the next discount array, the potential resistance, where we do see some, again, retracement right there. That is exactly what this is all about. And this is a case study on the dollar that we did as well. So now let's move on from the dollar case study to an Australian dollar, US dollar case study right here. There's also a screenshot I took yesterday actually. And I mentioned this area is where we can now continue higher, not the area above and not the lower area. So this exact fair value area right there is where we can now continue higher from. Not the fair value area above it, not the fair value gap above that fair value area, not the fair value gap below that, no order block below that. That exact area is where we can now continue higher from right there. Now, why did I mention that? If we take a look at Australian dollar, US dollar again, then what do we see? We see the highs that we took and the resistance that we run into overall. So again, the bullish hand, the bearish hand, the pushing battle right there, there's some resistance that we are running into. So we can overall expect a bigger retracement, not necessarily a sting into a fair value gap alone right there. So right here, if we now want to continue higher, then this fair value area is already the more interesting one, because that is where we can expect a bigger retracement too. But we can confirm this by the day that we want to trade. So Monday right there doesn't have news supporting the ID. So do we see a rejection based on price? Yes, but time, the day is not supporting the ID right there. So that is where this, once we come into that and we reject on that day where we have news supporting the ID, the next day is exactly where we can now look to continue higher off of that. This is extremely crucial, again, to understand right there. Now, from those case studies, we are now going to move on towards the last slide, which is, of course, practice again. Study how far we can retrace. Focus on the pushing battle. That would be my advice right here for the practice. So let's go over some charts right here as well to see how far we can retrace, etc., and focusing on that pushing battle as well. If we take a look at Australian dollar, US dollar right here, then of course, whilst we continue higher, we can now see fair value gaps right here actually being created higher. Now, the thing I would love for you to focus on is focus on Australian dollar, US dollar, on the dollar itself, EU right there, Euro US dollar, GBP US dollar, maybe even the indices right there, where the draw on liquidity is already quite clear. So we understand this has a high probability that it actually wants to continue higher the coming days as well. Now our focus is, all right, how far are we actually going to retrace right here? Will we retrace into those overlapping defenses? Will we retrace back into the last line of defenses right there? How can we now find out how far we want to retrace? But currently, to give you a little hint, I would expect right here only not significant retraces anymore. Only small retracements, things into fair value gaps, most likely to continue higher off of that. Now, you try to find out why I think that and why I think only small retracement right there will happen before we actually continue higher as well. I might be wrong and we'll see what happens right there, but that is good for your case studies as well. So I would advise go over Australian dollar, US dollar, even go over a few GBP pairs. If you do want to, you can go over GBP, JPY, GBP, New Zealand dollar. But since the draw on liquidity here is already quite clear, Australian dollar, US dollar, EU, GU, New Zealand dollar, US dollar, etc., it becomes a lot easier as well to study that. Now we have gone over retracement, which we want to go over on this Wednesday. Then next video will be about the resistance. Now, we have gone over the basis of resistance right here, but we need to go way more in depth on that as well to get a better understanding of the conditions we actually are looking to trade as well. All right, perfect. Thank you.